Welcome to Talk Tickers. Today we are digging into the Q4 2025 earnings call for Texas Capital Bank. That's ticker TCBI.
Okay, let's just jump right in, because this one was a real head-scratcher. Texas Capital comes out, delivers this massive earnings beat. We're talking over 16% above what analysts expected. And what happens? The stock ends the day down. So what gives? That's the puzzle we're going to unpack right now.
And wow, what a beat it was. Just look at these numbers. Adjusted earnings per share, $2.08. The street was looking for $1.78. That is a 16.6% surprise to the upside, an absolute blowout. Revenue also came in a little bit ahead of expectations. I mean, on the surface, you just can't ask for a much better quarter than that.
So with results like that, you'd expect management to be pretty confident, right? And they were. The whole message on the call was basically this: our multi-year strategic rebuild is done. It's over. We're not transforming anymore. We've shifted into what they're calling scaled execution.
And they brought the receipts to back it up. They're showing this new diversified business model is really firing on all cylinders. You've got commercial and industrial loan commitments jumping 25% in a single quarter. The fee-generating parts of the business are just humming along. Securities volume up 45%, syndication volumes up 40% year over year. And they're doing all this while growing their tangible book value by over 13% and keeping a rock-solid capital ratio of 12.1%. It looks good.
The CEO, Rob Holmes, really put a fine point on it with this quote. This is management basically telling Wall Street, look, the hard part, rebuilding the engine, is finished. Now it's time to put the pedal to the metal and show you what this thing can really do.
Okay, so amazing quarter. A victory lap from the CEO. Where's the disconnect? Well, it all came down to one thing: the guidance. The market is always looking forward, and it looked right past these great Q4 results and honed in on some pretty serious headwinds management is seeing for 2026.
And this is where you can really see that bull versus bear tug of war playing out. The bull case? It's right there in the fee revenue guidance. They're guiding to $265 to $290 million for 2026. That's strong, and it says this new diversified model is working. But the bear case is just as obvious. They guided the provision for loan losses higher, up to 35-40 basis points. That's a noticeable jump from 2025, and it's a huge red flag that signals they're getting cautious on credit.
And it wasn't just the higher loan loss provision. The guidance revealed a few other things that definitely spooked the market. First, a big step up in expenses is coming in the first quarter. Second, they pointed to an uptick in special mention loans in multifamily real estate, which is sort of an early warning sign for credit issues. And third, they came right out and said they expect their commercial real estate book to actually shrink by about 10% next year. So the market heard rising costs, potential credit problems, and a shrinking loan book. Not a great combo.
So how did investors put all this conflicting information together? Well, you just have to look at how the stock traded. The price action really tells the whole story.
And here's exactly how it played out on the tape. The stock was sitting pretty above $104 before the call. It opened lower, and the selling was just consistent. It bled lower all day, closing down 1.25% at 102 and change. Not a total disaster, sure, but a clear thumbs down on the report despite that huge headline beat.
Now, this piece of context is absolutely crucial to understanding why it played out that way. You have to remember, TCBI had been a monster performer. Over the past year, the stock was up nearly 25%. That almost doubles what the S&P 500 did and what the regional bank ETF did. The stock was basically priced for perfection. So when the outlook they gave was anything less than flawless, traders didn't hesitate to hit the sell button and take some profits.
So that really covers the what and the why of the quarter. Now let's pull it all together for our final segment, the next call. This is where we put it all together, form a thesis, and give it a rating.
Our rating on the stock is market perform. Look, the transformation story is real. The diversification is impressive. You can't deny that. But management's own conservative guidance on both expenses and credit just creates too much near-term uncertainty. It perfectly balances out that positive long-term story, at least for now.
And that brings us to our outrageous but plausible trade idea. Here's the thesis. What if management just kitchen sinked the guidance? What if they know the macro picture is murky, so they're deliberately setting a super low bar for 2026, a bar they know they can easily clear every single quarter to create a pattern of beat and raise? So what are the catalysts? You've got to watch the Q1 results. If expenses come in better than feared, and that strong fee revenue actually shows up, then you know the thesis is working. And the trade? You could think about a pairs trade. Go long TCBI, betting on this unique fee-driven growth story, and at the same time short a more boring, traditional, rate-sensitive regional bank. You're betting that TCBI's new model is a real advantage that the market is overlooking because of this cautious short-term guidance.
All right, that's our take on Texas Capital. Thanks for tuning in to Talk Tickers. And as always, remember, this is not financial advice.